think that did it. Okay. All right, we'll do a little bit of a sound test here. Should be okay. Give it a minute for people to get in here. So I have some stuff I want to review today, but while I'm waiting, just so you know, I've been changing the format on this a little bit. It's a little bit more qualitative rather than quantitative because it's harder to show the charts, although we are going to have to discuss some technicals today. So if you have some stocks or if you have some themes, really more like it, that you want me to discuss, post them and we'll cover them. I'm just watching the screen here. Okay. IBB, of course, SPY, TLT, oil, we'll discuss that. Anything else? High yield, the VIX, these are all the right questions. All right, I think that's a good amount there because that, believe it or not, covers a lot of what I was planning on discussing. So let's jump right in here and start. First of all, if you happen to catch this late or if you want to watch this video again at some point, all you have to do is go to my YouTube channel. It's Justin Pulitzer Trades. I highly suggest subscribing there. You'll get notifications when I post weekend reviews and Periscope rebroadcasts that, like this one that will be up on the site later. Obviously, a lot of you know me from Twitter. I know that there are some Periscope unique people here. So if you're not following me on those other ones, be sure to get involved there as well. Anyway, let's start. So today we had a bit of we had some technical difficulties. How's that for a title for this? We basically opened up, we kind of had a weird setup today. You had some Fed governors. Yesterday, Lockhart came out and was talking about every meeting being live and April being on the table. And then today you had Bullard and a couple of these other guys who basically were coming out and saying, data dependent and, every meeting is live and so on and so forth. And I think that the Fed is doing a tremendous disservice to themselves and their credibility with statements like these, because we just heard Yellen in her press conference basically dove it up. And now these guys, I guess, are trying to come in and do some damage control, it seems like. They're trying to kind of make it seem more hawkish than dovish. So to me, what struck me today as the reason, the quote-unquote why we were down, as you know, in SPY, we've been kind of hovering up around the breakdown level, the gap fill from where this big correction for this year started. And it struck me is that we've had like 3 or 4 days of consolidation and that we would probably either go up and press higher, get, kind of squeeze out the last of the shorts, suck in the last of the late longs, or there would be some type of a failure where we would go down. And today was, I guess, a glimpse of possibly what that failure can look like. It obviously still needs to confirm, but there are some technical issues that I saw today that have me thinking that a down move is very possible. I will discuss what a failure of that down move would look like as well. So this is what struck me today as the problem. So I was looking at the CME website. They have this website. I'll post the link in the description of this video on my YouTube rebroadcast. But the April meeting was, before today, the probability of a quarter-point hike was 6.9%. Today, that jumped up to about 14 at the close, so you basically had a double there. Really not that big of a deal in my view. I think April is never happening. I think that it just got too low, and you always have some people looking to throw some money, on kind of the cheap bets, looking for a big payoff. But the idea behind that to me is, like, for example, I'll give you the long shot, like Jeb Bush, for example, when he was running for president, he was trading at 22 to 1, and then after his like first better debate performance, he like got better to 16 to 1, and then wound up dropping out like a couple of days later. So I don't make much of that when you're kind of in that long shot area. Yes, this was a big move. To me, what the more important move was, and this is what the market reacted to, was that there was the probability of a hike before September. After the Fed press conference, the June-July probability came off. And today, you have July now trading at 50% probability of a hike, and that is up from yesterday of 39.7. That, to me, is a problem because the market was starting to discount further rates coming in September and possibly in December. Now they're seeing possibly in the summer. I don't know that that's going to be the case or that's going to hold. It struck me as interesting that, the Fed came out and said they were going to hike rates, and every time they seem to open their mouths, TLT wants to rally, right? I mean, they talk about rate hikes and rates go down. So that to me was striking. You also had some weaker home sale data that has been weighing on the market. Tomorrow, I think we're getting durable goods also with, I believe ADP is tomorrow. If someone could just type in the chat here, I think tomorrow is the ADP unemployment number. So you had the weird setup of the Fed acting funky. Yesterday you had poor highs in the market, and we experienced a liquidation break into the close. And then overnight it was kind of choppy. You had a bit of an up move and then down. It was sort of a mixed inventory. But the liquidation break continued, and then at 10:30 today, the oil number was huge. The build was really big, and oil was already kind of a little weak going into that. And I think that just kind of set up with profit taking and people not wanting to necessarily go into the long weekend. Today is Wednesday. Tomorrow is the last day of the week. Friday is off for Good Friday. So, we've had some terror scares. The market handled that in stride yesterday. And then I guess today was maybe a little bit of the hangover of that move. You've also had some really, really large moves in some of these commodity names, like let's say the Freeport-McMoRans, that had rallied from $3.52 and topped out at $11.45. That's a pretty big move into itself. It wouldn't surprise me to see a little bit of pullback. Same thing with a lot of these, let's just say with oil. I'm looking at CL. You had basically gotten up a couple of days ago to just under the 200-day moving average, which has been resistance before. The last time it had the touch was on October 9th, and that was kind of grim death after that. So here we're having a bit of a pullback. Makes a total lot of sense that we're getting some pullback and consolidation in these names. So I had discussed, I believe in Periscope last week, that I saw two likely scenarios for the quarter end, because we had the big options expiration last week. Next week is obviously the end of the quarter. So I said that I saw either this week being a ramp up and then next week being the lock in and sell off, or this week kind of being the shake and bake where we pull back this week and then next week we kind of get the rally into the end of the quarter. Listen, this is just my brainstorming and hypothesizing of what I've noticed as being likely scenarios in the past. But I will say this, I like to go by technical levels, and I'm seeing a couple of things that are disturbing me. First and foremost is with SPY, you have a bit of a mini double top on this leg at this 205.23. The first one was on 317, the second one was on 322, and you basically have had 3 days or so. You had the move up that was on 317, and then the last 3 days have just been consolidation. And then today, you broke a key level. The last few days, like I said, we had filled that gap, the 203.87, and overshot a little bit. And we actually stopped right to the maybe to the tick or maybe a smidgen over the 78.6 Fibonacci retracement, which is quite a bit actually. Usually if you get above 61.8, it's pretty bullish. So, which we did, and that was the taking out of the downtrend line. So it makes sense that there was some consolidation here. My thinking, though, was because we had filled the gap and we didn't pull back right away, was that we might spend some time sideways and then have what kind of like one last push up to get up to close to like the 206.76 area, 207-ish area. But it seems like we're getting a pullback instead. I will say this, that on a few occasions, the last time, the 820, and then again, that was the first kind of preluded the flash crash, and then again on 1231. Anytime we've had closes from above below 204.12, it has led to, I don't want to say catastrophe, but very steep, large down moves following immediately, actually. The next days were the one that took place on 820. The next day started off, I think, mild. They tried to fill the gap. It wound up being a catastrophe down to 197.80, but even below 197.86. And then the following Monday was the flash crash. And then on 1231, we know how the year opened up. We had a very large gap down, an attempted rally the next 2 days, but it was just too much, and we wound up going all the way down to the 181s. So obviously, we need to confirm, we would need to see weakness again tomorrow, and then I would say that, the risks start getting to be more to the downside. If we were to clear today's high of day, which is 204.33, I would say that this day was a look below and fail, and then that the move then is then to the upside, maybe for the rally into, quarter end. So we're kind of on eggshells here. I just want to say that. It's kind of like it's the musical chairs. We're kind of close to when the music is going to stop. At least there's got to be, I believe there's got to be some type of a pullback soon, because we're getting into breakdown levels where people are being made whole. They were sort of like the hope and pray camp, and now they're getting their money back, so they probably will take it. And you have two distributions up here now of price. So it makes sense that there's a pullback. It's just a matter of from where up here. So that's sort of my thinking. And one other issue for me, and I discussed this in the weekend review video, was the VIX. It was good that we broke the kind of the new up channel that was forming, but we were getting down to kind of reference lows. The last few days has had kind of like poorish looking lows in the 13s. Yeah, I said you could try to play it for the 11s, but it would be, for me, that's really not where you'd want to be playing. Kind of playing for those last couple of points is dangerous, and I had talked about maybe looking to buy some SPY puts or SPY put spreads to start layering into those from 205s up to close to 207. I even had taken a shot at buying that TVIX a little bit, just to kind of for shits and giggles, so to speak. So you had a close today in the VIX just below 15, although we tested into 15. I had said in the weekend review it would surprise me if we didn't have some type of a move back over to the back of the down channel where the breakdown had taken place. That roughly coincides with 1605. So we could see a little bit more down, believe it or not, or at least a little bit more move up in volatility before before you could even say that this is becoming a problem. Like that would still be, believe it or not, a healthy move within the VIX, and it would still be within kind of reference range. With regard to ES, I know not everyone always trades SPY. I've been getting increasingly more questions. What does that mean in terms of ES? So the answer is 2032.5. That is your key level here. Any breaks below there have been met with not such good outcomes, and we are slightly below there. I will say this with regard to SPY, if it wants to pull back and like not fall apart, let me give you the next series of levels. We always take it level to level. We are overbought stochastically. We got basically back up to the breakdown point. We even went a little bit through it. We had the gap fill. If we pull back, the next really key level, and I would say would still be quote unquote healthy, would be the 20190. That is a old reference high from a while back. It's also roughly where the 200-day moving average is now. That's 20182, so roughly there. If that can hold, then it's hunky-dory and we're okay. If that breaks, then you're talking about the 199.96-ish area, those hammers, and then 197.86. Anything below 197.86, of course, has us well below the upper echelons of the distribution. Forget about the upper or the upper middle. That's like the end of the kind of the topping distribution process. Anything below there to me is really, really super vulnerable to a massive market correction. Obviously, we're not below there now, and it's quite a ways off, and today was just, a down day. We've had multiple, we're working off a little bit of excess. It's possible just to have some, some pullbacks, but, we had gotten a little bit far away from a 20-day moving average, although that's caught up quite a bit. It's roughly around 2058 now. The 50-day is still a little bit low, though, around 194.02. If we were to lose, I would tell you this, if we were to lose the 201.90, the 200 MA, I'm going to probably start thinking that a 50 MA test could be possible, and we could pull back even as far as 195. That would roughly be about 100 points in the ES, and consistent, I think, with what we've seen in the past. So let's just keep it really simple, stupid. Anything below 204.12 to me is iffy, bearish to iffy. Above there, it's neutralizing to up. I do think that it's healthier if the bulls do some sideways consolidation here. There is absolutely nothing wrong with that. You could even use the Fed day range, which we of course know the low there was 201.55 and the 203.82. Today's close was in there, but it was like just to like where the body kind of gets started. So like I said, today was bearish, but it wasn't definitively bearish. If we are below again tomorrow, the 204.12, like if we don't kind of like bounce right back, I'm going to be a little bit increasingly more suspicious. IBB, that had been kind of trying to bounce. I think there were some allocation trades in there. That also is a risk monitor. That's why I want to talk about that now. We stopped just shy of the 50-day moving average. Took out, first of all, we took out yesterday's, we closed below yesterday's range and back below the regression line. So I'm still real iffy on these IBB stocks. I've said I thought I could see the 207 to 212 area. I'm still a little bit concerned with regard to the IBB. Some other indices that are used as kind of the barometers of risk. The IWM never got back into the upper distribution. It was kind of just kissing the volume distribution, and now we closed today basically right on the 20-day moving average. So right below the 100, today's high, after having closed above it 3 days in a row. So I would say that we're probably a little vulnerable in the IWM below the 100-day moving average, and I would say that the 20 here and then the 50 could come into play. So let's keep an eye on that 100-day moving average. If tomorrow takes it back out, I would say today was sort of an aberration. So we're going to have to, see the confirmation tomorrow. With regard to the Qs, somebody who I respect, who follows me, mentioned today, do I make anything of it that the NASDAQ hadn't reached the 200 MA? That is true in the comp, but it isn't true in the NQ, and it's not true in the Qs. Those both are basically hovering right around that 200-day, 100-moving day average confluence. It's also roughly the 61.8 from the top to the reference low. I would say that it was funny today. Up until the kind of the end, the FANG-ish names were holding in a little bit better than the rest. Like Apple had been green for a little bit of the day. It wound up closing down more negatively. Facebook closed green. I've been on the record since really the beginning of the year, even the end of the year last year, saying that I thought Facebook was the best of the lot. with regard to FANG. Google was weak. It closed negatively, although not, I mean, for Google, $2 is really nothing. Where's Netflix? Netflix, again, back below 100. You know, for a while, that stock has been really frustrating. I've played it well, both long and short. For some reason, Netflix, whenever I have like the short of the year, it always winds up being Netflix. Like, I always seem to be short Netflix at the right period of time. It's just like historically, for whatever reason, I'm really good at timing shorts in Netflix. But we're still on trend right here. You've had a couple of days of begrudging selling. I would be, it's through the 50 MA. It's basically just consolidating. You know, I would watch tomorrow as a key. If you snap the trend tomorrow, then you might have a little bit of a runner down to the 50 MA. If it can hold and rally, then you're probably going to see the 103s, maybe even 105s. Keep in mind we have some pinning action that's going to take place tomorrow, so as crazy as this sounds and as frustrating as this will be, we might not even have a definitive answer tomorrow. We could do something like silly, like just pin on low volume. With regard to SPY, I'm sorry to be all over the place, bouncing back and forth. The expected move for tomorrow is really rather kind of limp. It's only $1.19. So we could have that move back to the 202 and just like kind of sit there and then being on eggshells to know if we're going to hold or not. Where do you see the SPY at long term? Do you mean where do I see it going longer term, or where do I see the support longer term? Please be a little more specific with that. Longer term. So the answer to that is simple. I don't really like to think like that. I like to think from level to level. I have longer term themes and thesis. I've said that it wouldn't surprise me, believe it or not, that we have some kind of a major blow-off top here. Everyone thinks it's going to top out and go lower. We could easily go higher. But I like to think of it level to level. It's sort of like if we're above 201.90, then I think 204s are in play. And if we're above 204s, then I think 205s and 207s are in play. But if we're below 204.12, you know, it could be back to the 201.90. I just kind of take it from level to level. I just let the technicals ride there. Yeah, exactly. I let the levels lead me where they may. I find that the 6 inches between your ears are often the ones that cause the biggest losses, meaning your brain. You overthink things. Although I'll tell you, for people who overthink, I love to overthink. I overthink almost everything. It's just basically who I am. But I will tell you this, I noticed that the more I just surrender to the levels and I just let them lead me, the better my performance is. So you know, everything is important in context. I will say that, you know, you can't just say, oh, you know, I say an area is a buy area and then like it bounced just above there, went up and then comes right back there and, oh, you know, I'm not going to buy that blindly. I know that we've been close to there and that level is probably not as strong as support. Or the same thing with the move to the upside. You know, like I'll say, okay, you know, the gap fill could be a short here, but then we spend 3 or 4 days, you know, going sideways like we did here, and then maybe it's not necessarily such a short. You want to play either long above the range or short below the range. Today, I will say this, we did have a move below the range. So if you want to play short, you can play it against today's high of day. Really, I can't knock that trade. I actually think it's a solid play. And then, like I said, you know, a drop of a dime tomorrow, if we were to get back above tomorrow's high, you could cover that short and then flip long. I mean, it's really, honestly, I know most people aren't built like that, but it's really just that simple. I keep it that simple. So let me talk to you one more time. I know I've been getting a lot of pressure from you guys, and I kind of have been a little bit of a tease about, thank you, I appreciate the confidence. I know I've been a little bit of a tease about doing the bond special edition video. The reason for that is because it's an in-depth video and it's going to take a lot of time to plot out. Believe it or not, there's a lot of intricacies that go into bonds. Bond managers are always concerned about a few things, convexity and holding to duration. I don't want to get too into that for the purposes of this video, but it's like some mathematical kung fu when interest rates change along the curve, the yield curve when you sell, or what, basically your holding period. But let's not get too into that. For the purposes of this video, what you need to know is that the reason why, and nobody seems to understand this on TV, that everyone's like, oh, why is the stock market holding up so well? Growth has been slowing so dramatically. The GDP is so weak, and we have an earnings recession, which is very true, we do. But why is the market holding up? And the answer is very simple. I mean, it's almost like keep it simple. This is like fourth grade finance, frankly. You have low interest rates. You have historically low interest rates. I mean, we have very little growth, but you have companies being able to borrow at interest rates that are lower than what governments can borrow at. I mean, that is absolutely incredible. You have a PE multiple premium into the market based on the lower for longer Fed interest rates. And every time they open their mouths, these dummies open up their mouths and say that they want to raise rates into a slowing economy, that premium has to be taken out. So if the Fed hikes interest rates into a low growth economy, there's no need for a premium anymore. So you sell. And that's why when the Fed hiked interest rates, you got a 200-point sell-off in the S&P. That's just how it is. I hate to say it's that simple, but that's just how it is. And the next time they raise interest rates, the market's probably going to go down again, because the premium, the multiple that is put on S&P earnings has to come in as interest rates go higher. It's really that simple, and we're very sensitive because we're at a very low end of range. So like to double the rates isn't very hard here. So today you had like I said, you had the Fed come out and they opened their chatter boxes. A couple of these guys opened their mouths, and the TLT had already kind of held its support range. I had talked about the 127s. We held there, and now we rallied back up basically to 130. Did we get 130? Of course, we got 129.82 with a fairly solid close today. It could have been a little bit stronger, but we're roughly holding the 50-day moving average with give or take a little bit of time. But we're trading on either side of the 50 as long as you're basically trending up. I mean, all the major moving averages except for the 20 here, you have the 200, the 100, and the 50 all sloping up. It's bull market for bonds. So it's sort of hard to say that the market should be dumping hard when you have interest rates this low. I always give the to kind of drive it home. If you picture a top number, a bottom number, and an end product, let's focus on the bottom number for a moment, because that's where you factor in your quote-unquote risk-free rate. If that number is higher, your end product is lower. If that lower number is lower, your end product is higher. And that end product is the PE multiple. Your amount that you're willing to pay for discounted cash flow earnings. That is the story. So as long as the bonds can keep the bid, you will have a stronger stock market, PE multiple. If you have a higher interest rate, you will have a lower stock market PE multiple. It's really that simple. Today also you had weakness, like I said, the weakness in the oil. That factor is really important to me still. I know that it's been kind of being poo-pooed lately, but we're still very tied to oil. Very large percentage of the S&P 500 are oil stocks. Some of them have gotten quite high. Chevron, I had said I think could get to 100. It probably still can, but like for example, if you're buying Chevron at 97, 91, are you the smart money now playing for 100? Probably not. If you were the guy in the 75s and the 80s, like when I was talking about buying Chevron, yeah, you were a little bit smarter back then. The 200-day moving average had been a really big problem for Chevron for a while, and that's down in 88s right now. Yeah, it'll probably rise a little bit, but I'd be more inclined to buy a dip in Chevron down near, like, let's say, a 50-day and 200-day moving average confluence, which is coming up soon. So if they keep dumping Chevron, that would be the spot to kind of maybe look to sell the puts into, or even to nibble on. Not, after it's had multiple days up. Exxon today held up rather well. That had a really big breakdown around 84.70. We've been sputtering around up there and trying to get through it. It's been a little bit of trouble. We had back on in November, we had a little time above there, but it was met with sellers around 87s, which is really where the next big volume distribution picks up. Same thing with that. As long as you're above 83 in Exxon, the chances of going higher are there. If you start getting below 83, it starts getting a little bit squirrely, and I'm going to start thinking maybe we have a move back to 80, 81. Again, all by the levels. High yield. So in the Fed statement, I have it around here somewhere. I have my chicken scratch here with the Fed statement. I basically highlighted a few things I think that they follow, and one of the things that they basically said that they watch are the S&P 500 and the high yield, the HYG. Very simple. HYG has had a pretty big run off the lows. It basically stopped just shy of the big 61.8 from the 2009 crash low to the peak. We didn't quite get up to the 200 MA, but we did get quite high. As long as that's rallying, it's good for stocks. If that's dumping, it's not so good. Yeah, that's kind of like your proxy for distress. The 100-day moving average is an important level. It's not fully bent. It's not even bent up yet. It's like first flattening. It's still in a downward slope, which is a little iffy. 100 MA is a really important technician number. Everyone makes a big deal of the 200 MA, but the 200 MA to me is really not even that important. For me, the ones I really watch, if you really want to get nuts and you want to talk technicals, the 21-day moving average is really important, as well as the, I like the 50 is always what everyone talks about. It's one that the algos are keyed into. But the 10 and 11-day moving averages and the 21-day moving averages, if you follow those and you want to be a true Fibonacci moving average guy or gal, that's really the numbers you want to watch, which side of those you're on, particularly the 10 and 11-day. The 200, though, you can trade through it very easily. I know it gets the media excited, and yeah, I mean, it's a trade. I mean, I'm not going to lie. Sometimes I mentioned before, I forget which stock it was, I had said that the 200 MA had been a problem before, or it had been, support before. So yeah, I mean, listen, it's not a blanket rule. It's different stocks respect different moving averages. It's weird, you just have to kind of know which one. It's like dating. Some people like blondes, some people like brunettes. Some stocks like the 20, some people like the 50. It's just sort of like that. It's just really how the market. It's really honestly that crazily simple. But some of the things that the Fed had talked about was the HYG. I think the Fed has been watching. They're making the same mistake they made potentially in December. They saw the market have that steep sell-off, recovered quite a bit, and then they thought it was kind of coast is clear. They came out and they got wackarooed. So I hope that they're not going to do something stupid like say, okay, HYG rallied a lot. We're not even back to the 38.2 fib retracement from like the last peak to the move down. You're not even half back, and they're out there making, out there grumbling around. So, yeah, they better kind of pipe down a little bit. We're going to have to see what they now, yesterday, like I said, Bullard shot his mouth off. I'm sorry, Lockhart shot his mouth off. And I don't think the market really took it too seriously other than a few minutes. But now you have a few more of these Fed governors grumbling. So we'll see. They're probably going to have to price in, the possibility of sooner hikes. I don't believe that they're going to hike sooner. I think they're going to play wait and see. The Fed was really nervous. This was the last meeting. They were really nervous about international growth. That was like the big theme here, global risk. I'm looking at my little sheet here. Global risk has a big star next to it, and they mentioned it multiple times. Since then, we had a major terrorist attack again in Brussels. That's got to make them even more worried about global risk. That is not going to do wonders for the economies in Europe. These are economies that are heavily dependent on lower energy prices. They have high unemployment, and they need tourism. And you're probably going to have a tourist scare this summer with the Zika virus. That's why these cruise line stocks can't get out of their way. and some of the travel stocks today had issues. But you add in terror to that mix, and it gets a little iffy. I've talked about the rate of change slowing, meaning the economy is still in decline, but the speed at which it's declining is starting to slow. I don't think until you see that kind of neutralize, at best, the Fed is going to really do very much about it. And they were talking about I already discussed not today, but I've discussed the inflation-adjusted incomes. A lot of that, I believe, is because of the energy drop. They want to verify that the labor market move is sustainable, so that's going to be important, obviously, to see these jobs numbers. They talked about the Fed funds rate remaining historically low. The neutral Fed funds rate, I told you guys now, write that down. You could even tattoo it to yourselves. That is the new code for lower for longer. Whenever you hear them talking about the neutral Fed funds rate, just think to yourself lower for longer, because that's really what they're trying to say. They just don't know how to hashtag, because those old fogies don't know how to use Twitter. So they say things like neutral Fed funds rate. There was a couple of other things in here that were really important to me. They were doing a little bit of double speak. This was like a kind of a what are you talking about, Willis type of moment. They were worried about that they haven't overshot their 2% objective, but then they were worried about being behind the curve with hikes, or maybe being behind the curve with not hiking. It's kind of it was kind of a lot of doublespeak. Honestly, this was a disaster. Their press conference, and that's probably why these Fed governors are coming out and talking so tough. There was so much doublespeak here, and I honestly was confused. And if I was confused, that's really rare, because I've taken courses on the Federal Reserve. I have been pretty accurate as far as my depiction of some of the things they said. I will say this, though. I'm kind of going to discount some of this tough talk out of these Fed governors, and I'm going to stick with Yellen on this, because what she had mentioned is correct, except some of her back talk with when she was pressed with questions about worrying about being behind the curve. One thing that stuck out to me that I don't think stuck out to everybody, and this is really important, when they talk about the 2% inflation, they said that they don't want it to overshoot. Now, this was important. They don't want it to overshoot, but they use this word symmetric. So that to me means they want to have symmetry, meaning that we've spent X amount of time below 2%. Maybe they're willing to let us spend that amount of time above 2% to even out the symmetry. That to me would actually be very smart. I don't know if it's in the old lady. Yellen to think that outside of the box, but we have spent so much time below 2%. They probably should allow the economy or the inflation to get a little bit above 2% to make sure it really sticks. You don't want to have a move above 2% and then crash right away. You want to kind of make sure it's sustainable. So it sounded to me like the Fed is starting to get on board with the idea that, first of all, they don't even see themselves getting to 2% for 2 to 3 years, which is really quite scary. But even when they get there, they're willing to be above it for a little while. How do we get above 2%, though? How would you get above 2%? You'd have some growth. There's a lot of talk. Trump has been talking about repatriation. I'll tell you, if they start allowing foreign companies to repatriate money with the kind of earmark that it's used to hire either domestic employees or for capital improvements, not just stock purchases and dividends, you will see a huge boom in the economy. That to me would be really rather smart. Listen, anyone who's followed me for a while here knows that I tend to lean right in terms of my political beliefs, but I'm not a total ideologue. I'm practical, and I don't believe in just repatriating money and just allowing it to be used for this nonsense that they've used QE for, with buying back stock and paying out dividends. Let's use it to bolster the economy, build our infrastructure, actually do something good for the economy. And if you're going to give corporations that type of a discount, let them do something. They need to work on the unemployment rate here, not the employment rate in Shanghai or wherever the hell they're building their Apple and company are building their plants. So I think if that you have some type of a repatriation, it seems like we're going that way. Maybe that's also the reason for the high dollar. The market senses that dollars are going to be in demand. These companies are going to wind up having to sell out of the currencies they're in and have to buy U.S. dollars. So that could be a bit of a concern also. So that's a bit of an issue for the Fed, by the way, and also an issue for commodities because they're all priced in dollars. So that would be good for Europe in the sense that they would have their energy prices suppressed, but it would also weaken their currencies because Apple or whatever companies hold euros. They'd be selling euros to buy dollars. So that's something else I think the Fed needs to really keep an eye on if that's going to happen, and maybe they would do that. I think the smartest way to do that would be to have schedules, windows when they can do that repatriation, although the market will probably start trying to game that. If I were in office, and I'm not, I would do it by industry, like, first quarter tech can do it, second quarter healthcare can do it, third quarter, industrials can do it. I would pace it out like that so you could kind of smooth the curve there. But unfortunately, if you've ever been to the DMV, they don't do it quite like they would in a think tank. They will do it probably the most arcanely and most inefficient way possible. So just keep that in mind. I'm just looking. I think that covers a lot of what I really wanted to discuss with you guys today. If there's any questions or comments, be sure to leave them for me. You guys help me make these videos better. Again, I want to just stress the levels that are important here. The SPY needs to get back above the 204.12, and in ES terms, that is, and this is the continuous contract, it's 2032 half. That's just the /ES. I'm not talking about the M6. Anyway, I think that's my story here. I'm sticking to it. I'll have more for you guys in the weekend review videos. No, I didn't discuss Gilead, but I could in the weekend review video. I'll mark that out. That I did discuss IBB. I think I've discussed IBB a lot in the past as well. I talked about people owning the ETF and selling, begetting selling, although Gilead today had some stock-specific issues with, I believe, with Merck with patent problems and an unfavorable court ruling. Anyway, if you wanted to watch this video again or you came in late and want to see it from the beginning, it's going to be on my YouTube channel shortly. That's Justin Pulitzer Trades. I highly suggest subscribing to that channel. It's frankly fantastic. Anyway, have a good rest of your week. Have a good Friday and Easter. I will see you guys again on Sunday night with my weekend review video, which should be we'll have tomorrow's results, so we'll know if it was a look above and below and fail, or if we go back up. Anyway, take it easy, guys, and I'll go over the charts with the levels and show you guys more detail in that video. Have a good one. Peace.